Hello, everyone. This is Divya Jain from BioAngels, and I welcome you to the fourth session of the Biotech and Healthtech Angel Investment Masterclass, a series of 6 masterclasses by industry leaders to help you understand the angel investing in biotech and healthtech sectors. These sessions will help to speed up on the dynamics of angel investing ecosystem and emerging practices with the help of trusted experts and curated content as you take the plunge into the world of investment. To give you a gist about BioAngels, it is a unique partnership between BioRack, an enterprise of Department of Biotechnology, and IAM, India's single largest horizontal platform for seed and early stage investing. BioAngels is India's first sector-focused angel investor group in biotech, health tech, medtech, pharma, clean tech, and agri-tech space that brings money, mentoring, and market access, echoing IAM's genetics. It brings a heady mix of private investor groups driving the investment process, along with access to domain and technology experts embedded in the government ecosystem through BioRack. Through this masterclass, we also invite investors to join BioAngels and discover and get early access to a pool of high potential startups in these sectors witnessing exponential growth. Moving ahead to today's topic, understanding term sheet basics of biotech and health tech startup. Term sheet determines the foundation of an investor's relationship with startups. In our session today, we'll be discussing the basics of term sheet, which outlines the offered terms and conditions under which an investment is made, and how both parties, that is the investors and the startup, will be acting to safeguard the investments. As it is essential for angel investors to understand the technicalities of a term sheet and the terms associated with it, we have with us Mr. Sanya Roy. Mr. Sanya Roy has 14 plus years of experience as a commercial transactional lawyer across various reputed legal organizations with expertise in covering venture capitalists, commercial contracts, JVs, and M&A, foreign investments, and corporate structuring. I welcome you, Sanya, for joining us today for this masterclass. Over to you.
Thank you, Divya, for the kind introduction, and a big welcome to everyone. And thank you to each and everyone for taking time out so close to the weekend and joining us for this term sheet masterclass. I can definitely say that we've been seeing a growing frenzy in investment across and globally speaking, and which is a clear sign of a robust investor confidence in the economy, as well as the startup ecosystem. Now, of course, a lot has to do with the recent experiences that we've had, with these, with a certain slowdown in the investor ecosystem. But the startups have been addressing these challenges pretty much head on. They've been reducing unnecessary costs, and they've been restructuring their operations to increase runways, and that has resulted in a lot of startups which have suddenly become more cautious, and their business models have also become a lot more viable. Moving on to the biotechnology space, we can see that there's a tremendous level of potential in this particular space, and we have seen an emerging interest on technologies that can tailor treatments to individual patients and deliver them, to target sites with greater accuracy. So we are talking of, medical sciences, but of course, biotech kind of spans multiple sectors and multiple, platforms, So things like cell therapy too, next generation gene therapies, precision medicine, drug discovery enabled by machine learning, new delivery methods. The list is, endless. So effectively, we are talking of, an immense potential in our hands right now. And, at IN, there is an extensive deal process and deal sourcing, which has been, pretty much the ground level work that is being done in order to source deals is extremely extensive. We have a very highly experienced team that is extremely immersed in the ecosystem, and they're constantly working in tandem, picking up very, very promising deals, which are essentially potential game changers and possibly industry disruptors. And of course, after the deal has finally made the cut after a very, very strict vetting process, that is when the deal essentially falls on our table and we start with the process of preparing the term sheet. And this is basically when the term sheet is drafted. Now, when you think of a term sheet, this is essentially the first legal document that the startup founder is going to see regarding the proposed investment. And essentially, yes, the term sheet is a non-binding document, but remember that it's also the founding, it's also, it's a foundational document to the whole transaction. And this is where we record all the basic aspects of the investment proposal. So now, generally, it is typically considered that a term sheet is a very, very standardized document. But in our experience, we've seen that it is rarely ever signed in a single go. We have often seen founders who are negotiating various terms of the term sheet, or there may be certain situations which requires that the term sheet be amended, modified, or we may need an entirely different term sheet altogether in order to make an investment. So these are the typical challenges that we come when we are in a term sheet stage. Now, a term sheet from a regular sector perspective is different, and of course it is different for different sectors, but from a biotechnology space, it throws up a very different form of a ballgame, and it's a very, very challenging process. So for us, the starting point is in getting a very deep understanding of each startup, each individual startup that is pushed through the vetting process and for which we're drafting a term sheet. And we do it by trying to understand the company's structure, the company's sector, its business models, and how the investment is going to be structured around it. So what this masterclass aims at doing is essentially taking you through the various aspects of a term sheet. And we are going to look at certain critical areas where there's a lot of negotiations that happen. There's a lot of back and forth. A lot of the times we have to, kind of redo the entire structure altogether in order to be able to make it fair to the investors, make it fair to the founders as well. So moving ahead, now what you can see here is basically the typical layout of a term sheet. Now the term sheet, you can see it on the screen. We put in a variety of information on there, but essentially if you look at it, you can divide it into two parts. The one part is all about numbers. It could be the valuation of the company, it could be the share price of the company, when we put in the pre-money, post-money cap tables, or when we are doing the tranching and milestones. These are something that are far easier to negotiate because they more or less come from a very, very, not so much as a fixed defined pattern, but we do see that there's a lot of convergence on these numbers for most of the time when we are, at least when we're doing the term sheet stage. Type of securities and terms of investment. Now you can see that these are the two portions that has been highlighted. The reason why this has been highlighted is because these are the two areas where we get a curveball very often, and these are the two areas that I would like to delve into in this session. When we make an investment, we typically have two options. One is a preference share, the other is a convertible debenture. Preference shares are essentially shares that have certain preferential rights over equity shares. These rights could be in respect of liquidation. These rights could be in respect of essentially having a certain right over dividends, etc. So typically, these are the two instruments through which we tend to invest, right? Now, at the outset, I'm going to make it very clear that a majority of the investment that happens essentially happens in the form of preference shares. They do not happen in the form of convertible debentures because convertible debentures are essentially debt instruments. So they don't give us the same kind of rights that we would like to have as investors. And when we're investing these rights, and these are the rights that we will be delving deeper into in the next slides, these become very important to us. And so preference shares tends to provide certain rights over the company that we want to ensure. Convertible debentures are therefore not the preferred option, although we have done convertible debenture rounds. And that has been pretty much on a very low scale, but it has been on a case-to-case basis, whether the circumstances were such that convertible debentures had to be issued, and the round was structured in a manner that there were other investors as well, and so there can be a variety of reasons that determine the securities. But yes, the preference shares are the preferred mode of undertaking an investment. Effectively, we have to also look at it from the perspective of a risk analysis, and that is something that we do all the time at IN. Is that whenever we're making an investment, risk analysis is something very, very crucial. That is one. Secondly is, how do we mitigate that risk? So using a preference share gives us the ability to mitigate risks to a certain aspect. Given the risky and very uncertain nature of the biotech space, God forbid, if a company were to go south and a liquidation event is triggered, then we have some respite if we have a preference shares, because then we'll have we get payouts earlier than the founders and the other shareholders. So preferential payouts in case of a liquidation event is one of the benefits of having a preference share. Preference shares, as you can see, are optionally or compulsorily convertible. They can also be redeemable. They're typically converted into common shares in a predetermined ratio. I want to kind of highlight that. The reason I want to highlight that is because in case of an anti-dilution, typically when there is a down round that is happening, having a preference share gives us the ability to tweak with the conversion ratio so that any negative effects of a down round can be mitigated in favor of the investors. So the flexibility to change the ratio in a preference share exists, and that is the benefit that we take the benefit of. When we invest in convertible debentures, our ask is typically to have the convertible debentures converted into preference shares and not directly into equity shares, for the same reasons as I have stated before, is that preference shares gives greater rights than equity shares. The typical type, and also remember that the type of security is predetermined mostly. It's not something that we typically go back and forth with the founders very often. There's often not a lot of negotiation around it. But that's the only reason is because we have kind of done a deep dive into the industry, into the sector, into the company, into the cap table of the company, and we are aware of what would be the best security instrument for the investment. And very often there is a meeting of minds on that much before the term sheet process has even started. So from a security perspective, preference shares is the #1 option to us. Convertible debentures in rare cases, and securities is not something that is really fraught in terms of negotiations. But yeah, it's definitely something that's on the top of our mind when we are drafting the term sheet. Now we are moving into the basic terms that is typically found in a term sheet. I've not listed out all the terms because there's obviously a lot of other terms as well, but these are some of the more basic terms of the investment. But I would like everyone to concentrate on the terms that are highlighted, because these are the terms which are the most heavily negotiated between the founders and the investors, and for good reason. And we have extensive experience in in negotiating these terms with the founders, with the investors, and trying to make sure that these terms are favorable, or not so much favorable, but these terms are equitable to both the founder as well as the investor. It's important that in the term sheet stage itself, there is a certain meeting of minds that we agree to the terms, and those terms are not something that we would want to reopen when we are looking at the definitive agreement. Yes, in a term sheet, the terms are very, very they're not extensive. They're absolutely not extensive as you would typically find in a definitive agreement. Yes, there is often, a kind of a, we are often tempted to, put more and more terms into the term sheet. But thankfully, what has happened for us is that in our years of deal making and, in the numerous investments that we have made, essentially, we have understood exactly what needs to go into a term sheet and what needs to be left out. So there is a very fine balance that we typically have to adhere to, so as not to overdo a term sheet, so that it does not start looking like a shareholders or share subscription agreement by itself. So that's a huge challenge, and that's something that we have kind of worked on across many years, and we now have a certain level of a standardization to say on a term sheet. But of course, we are agreeable to kind of tweak it as and when needed. So as I mentioned, the highlighted terms are the ones which are the most vigorously negotiated. The ones which are not so much negotiated, anti-dilution, liquidation preference, preemptive right, these are all the rights which are essentially, kind of standardized. So, I mean, if you were to put these terms into two buckets, so the first bucket would be the terms that are standard in the industry with little need for variation. So anti-dilution, liquidation preference, preemptive rights. And then there are those terms that are also standard to a large extent, but whose implementation process or whose finer details can vary between one investor and another. Or it can vary depending on the nature of the business, the nature of the company, the requirement of the founders, and we have to keep all of that in mind when we are negotiating or drafting the term sheet and thereafter the definitive agreements for the same. Now, the reason why founders or why these terms are heavily negotiated is because, remember, that these terms they either affect the manner in which the company operates, for example, in case of director observer seats or reserve matters, or because they affect the shares of the founders, for example, in the case of vesting or lock-in, or these refer to, or these pertain to actions and which say the founders become obliged to undertake upon happening of certain events, for example, exit rights, for example, or drag-alongs as and when they are triggered. So that's the reason why these terms are kind of negotiated. These are fine-tuned, and we have to constantly go back and forth. And we have to sit with the founders, we sit with the investors, and we try to find that fine balance all the time in regards to all of these points, and to ensure that whatever we put in the term sheet is equitable, it is fair to both the parties, it is keeping in line with the business requirements of the company, that it does not affect the business of the company adversely in any way whatsoever. So that's the intention with which all of these terms of investments are negotiated and the way in which they are drafted. So what we will do from here on is that we will take up each of these highlighted provisions individually, and we will go into a bit of detail as to why they are a bit negotiated and what kind of challenges that we see, and typically how do we overcome these challenges. So the first point is on directors and observer seats. Typically at IN, we seek one director and one observer seats. Observer is typically a silent observer. The directors, of course, are extremely engaged with the company. At IN, we from a director level, directors are very, very strongly engaged with the company. They provide valuable insight, inputs, guidance to the founders, and many of the founders are actually heavily indebted to the directors because of the kind of direction that they are provided to the founders and to the company as a whole. So that is one. Now, the founders often, while founders are actually fairly okay for most part with having a directors, founders also often seek to implement a threshold. Now, a fall away threshold basically means that for an investor, the right to appoint a director or an observer seat will fall away once they reach a particular minimum threshold. So for example, if an investor today has 10% of the fully diluted shareholding in a company, the term might provide that if the shareholding of that particular investor were to come down to say 5% or 4.5%, the right of the investor to appoint a director falls off. Now, these numbers are typically negotiated heavily. We've seen the threshold to be somewhere between 2.5 and 5%, and that is a kind of a sweet spot for all the investors and the founders as well. But for us, it becomes very crucial to understand the stage at which the startup is at currently when we're making the investment before committing to a number. Because in our experience, putting up a minimum threshold for a shareholding, it does not work with an early stage startup, where, say, for example, Iron is the only investor. It might work well for, in case of a company that has had some previous rounds, or where we're putting it as a follow-up round, and we want to set up certain parameters where which could be more of a baseline for negotiation for further investments, further rounds, or investors who are coming in further rounds. But effectively, a very, very delicate balance would require to be made. So yes, in respect of a director and observer seat, we are constantly talking to the founders, trying to understand their concerns. We're talking to the investors, trying to understand their concerns. We're trying to go back into the company to see what kind of a structure, what kind of a business, what are the rounds has it had, what is the position of the company before we finally take a call on how many directors, how many observers, and what is the follow-away threshold, if at all it needs to be applicable. And we are constantly talking to the founders and trying to explain to them the reasoning behind having a particular threshold or not having a particular threshold. So that's about as much for the director observer seats. Now, moving ahead, we go into the vesting and the lock-in period. This, I must say, is probably the most strongly negotiated point in all of the term sheet. And this has to be, I mean, of course, there's a reason for it, is because it directly affects the founder's shareholding in the company. And we have to, and we are extremely, extremely sensitive to the fact that the founders have put in tremendous amount of work, tremendous amount of commitment, a lot of dedication into the company. And we have to be very, very careful when we are drafting out the vesting and the lock-in provisions. There is, of course, also a challenge when you're investing in a biotech platform and you have a lock-in or a vesting provision, and we'll come to that. So vesting essentially is a notional term. It's a contractual term. There isn't anything much legal about it from the perspective that the Companies Act does not kind of consider what a vesting is per se. But essentially, a vesting means that the shares of the founder are deemed to be in a way restricted till the time a certain time period has passed or certain milestones have been achieved. Now, in our case, we have a 4-year vesting period with a cliff of 1 year, and the vesting is an annual vesting. We have very often seen founders requesting for a liquidity exception. This is typically when, say, the founder has already spent a significant time with the company, and we typically see around, say, if the company has been in existence for around 5 to 6 years, and we know that the founder has put in a lot of effort and time and their own money into the company, and we want the founders to have a certain level of liquidity exception, wherein that portion of the shares of the founder is considered vested and not locked in, meaning that the founders can transfer those shares in case of a liquidity. The number is typically at 5%. So when we are structuring the vesting provision, we say that 95% of the founder shares will be vested, will be effectively, it will be unvested, and the 5% would be vesting as on the execution date, and the founders have the right to transfer those shares to any person as they want to. Now, what we have to understand from a vesting perspective is that vesting has certain consequences on the founder. If the founder were to leave the company It could be because the founder has resigned. It could be because the founder has been terminated for cause. And any of these events will affect the founder's shareholding, the founder's right to their own shares. So we have to be careful when we are drafting this provision, because we have to kind of look into the circumstances of the founder. We have to look at the circumstances of the company. Things like, I think an even larger challenge that comes in is, particularly in the biotech space, is when you have founders who are probably not solely associated with the company, although they're designated as founders. They have certain founder shares in the company. There is a founder agreement with the company, but in the very traditional sense, where a founder puts in 100% of their time and effort into the company, a lot of biotech founders may not be putting in that. A lot of them may be doctors, maybe professors, researchers, who have other commitments, who have other organizations of whom they are a part, and they are not whole time associated with the company. Their shares are also vested. Their shares are also locked in, meaning that so the term lock-in essentially means that the founders' shares cannot be transferred within X number of time or without the permission of the investors. But we have to be careful in case of founders who are not actively engaged with the company, because in that case, typical provisions such as termination for cause or for the founder leaving the company, particularly for a founder leaving the company, does not apply, because the founders are not essentially 100% with the company at all. So that's with the vesting. I think one of the ways in which we resolve issues regarding vesting is being more understanding of the founders. We try to ensure that the founders get a certain level of liquidity exception, particularly when they have put in significant amount of time and years into the company, and to also understand cases in which wherein a founder may not be directly involved with the company, and whereby we may need to tweak the conditions under which certain unvested portions of the shares are affected. Moving on to the next is reserve matters. Again, reserve matters are pretty much standardized to a large extent, but we have gone back into our own master list of reserve matters, and we have been able to chop it down significantly, so that we are not unnecessarily burdening the company and the founders on reserved matters which are not really necessary. A lot of the way in which we have done it has also been sometimes to split those reserved matters into operational matters and strategic matters, and having a much more lighter approach to operational matters when it comes to how they are passed in an AVM, and having a more stringent approach to a strategic matter in regards to the same. So effectively, reserve matters are required to ensure that the company does not make a decision that is detrimental to the investors' rights, or it could be either financial or otherwise. But as a slight extension, when it comes to operational matters, we also put in a reserved matter list to ensure that the company does not make any missteps, because a lot of the founders are very new to undertaking a business. They're very new in regards to kind of corporate compliances that is required. So effectively, there's a lot of hand-holding that is needed, and reserve matters kind of protect not just the investors in our case, but it also protects the founders from making a mistake, because they will have to go to the board, and we ensure that the board is comprised of people who have extensive experience in that particular field. So they are very well aware of where the pitfalls are, and through a reserve matter, they are also able to guide the founders accordingly. Now, typically, as I mentioned, we've seen that the founders often do not want an extensive list, as it might affect the operational efficiency of the company. For that reason, we have split the AVM list, the reserve matters list, into operational and strategic, giving a different weight to each of them, so that in case, say for example, a particular reserve matter is not passed due to a want of quorum of the board or a quorum of the shareholders, then it should not affect the operational matters. Although the reserve matter, the strategic matters are of course of a very high importance, and therefore they cannot be dispensed with on that matter. Now, we will also typically see that founders request for a threshold, a fall-away threshold, as they do with a board director seat. And again, we have seen that this threshold is typically 2.5 to 5%. This is also depending on, again, the status at which the investment is being made, how many other investors are on the cap table, have there been any previous rounds, are we making another round, are we expecting other investors coming in future rounds, and so in order to have a baseline for those. So the same principles that we apply to determine a fall-away threshold for a reserve matter is the same that we put in for a director or observer seats. So that typically, again, like I mentioned, 2.5 to 5%, that is what we have. And on your screen, you can see a few of the major reserve matters that we typically seek for: alteration of MOA, which is essential largely because it kind of really affects the constitutional documents of the company; a merger, sale of assets, reorganization, acquisition, change of business of the company, because this really affects the core business of the company. Of course, as investors, when we invest in the particular business and with a certain expectation as to how that particular business will progress, will develop over a period of years. And any of these actions can, it can divert the path of the company. And we definitely want to ensure that whatever diversion happens there is to the benefit of the investors and of the company as well. And of course, related party transactions and appointment and removal of auditors. The next negotiated term is information rights. In fact, this is probably one of those rights which is not heavily negotiated. A lot of it is standardized. I think a larger challenge that we faced often is for very small companies who find it very difficult to accurately collect and collate and collect information. Sometimes we've seen that information rights also are subject to a fall-away threshold, but that's usually at around 2%. But even when that happens, we kind of negotiate with the founders to ensure that even if there is a fall-away, even once the fall-away has triggered, there are certain basic information that we continue to receive from the founders, and which basically will enable us to kind of keep track of our investment, keep track of how the company is doing, and the like. The last negotiated point is on exits and drag along. Exit rights, any investor that invests in a company is essentially looking at being a part of the growth story of the company for as long as they possibly can, but eventually they are looking at an exit. So exit rights and drag along rights are another very, very crucial component of a term sheet. We typically look at a 5-year exit period. Exit periods could be on an IPO, buyback, strategic sale, or any of the matters that is provided on the screen here. Typically, if an exit is not provided, then there is always the right that an investor has to sell their shares to all their shares to a third party. Now, that is where things sometimes tend to get a bit complicated, because if the third party now seeks more shares than what the investor actually has, then the investor would definitely need to trigger a drag. A drag essentially means that in the event the number of shares that the purchaser was to procure is higher than the number of shares that the investor has, then for that portion of the shares which is higher than what the investor has, then the investor then drags along, or requires the founders or the other shareholders or the investors to also transfer that portion of the shares to the third party in order for the investor to make an exit. So that is what a drag is. Now, drag essentially can be both against the founder's shares or against the investors or shareholders' shares. That is a point where we see a lot of negotiations, largely because while the founders may be agreeable to provide a drag on their shares, certain investors and other shareholders may not be so agreeable. In that case, we have to talk to the investors and try to understand what our priorities are, in respect of a drag, what our options are in order to trigger an exit in the case that a traditional exit has not been provided by us to us by the company. And in certain cases, we also try to include mechanisms of a tag on drag, which is essentially, we may not be able to drag a particular investor, but there can be a tag on drag applied, wherein say if a particular investor is dragging our shares and we refuse on a drag, then we have the right to have a preferential tag on those dragged shares. So these are essentially the typical framework and the negotiated points on a typical term sheet. While a term sheet is essentially a foundation document, it's a fairly short document, a very precise document compared to a more definitive agreements which go into a lot of detail over each clauses. But because it's a foundational document, it's also very important the way in which it is drafted. And at IN, we have kind of turned it into a form of a fine art in balancing the requirements of the founders of the company, of the investors, trying to understand how the term sheet needs to be molded around a particular sector, around current market conditions, and so that is the pretty much the idea with which we target drafting of a term sheet. So thank you everyone once again for patiently giving me a here on these points. Now we are opening the room for questions and answers, please.
Thank you, Sanya, for this enriching session and discussing the broad parameters and various conditions in the deal-making process with startups from the biotech healthtech space. We are now open to Q&A. We have a few questions from our audience. The first being, can we run more than one business, which is normal practice in USA? Elon Musk is leading example.
See, yes, you can run more than one businesses, but I think you need to understand the psyche of the investors on that, because investors are investing pretty much on the backbone of the founders. So what they want to see is that the founder is committed to the business that they are running. Now, if there is a split between the time and the commitment that the founders have to give to two different businesses, then yes, there is definitely a certain concern that we've seen of investors, because they do wonder whether the investor, whether they are better off investing in a particular company where that the founder is only giving, say, 50% of their time. But I don't see that as a deal breaker. But yes, typically that does kind of, it does raise a very small red flag to a lot of investors.
Right. The next question is, what is the role of a board observer?
See, a board observer is basically a silent observer. A board observer does not have any voting powers. They typically are there merely to kind of observe the, basically observe on the events at a board meeting, and then to report it to the entity that has nominated it. At certain times, we have also kind of structured a transaction to basically state that in the event, there are sometimes it happens that an investor may not have appointed a director on the board, but may have appointed an observer on the board. So in certain of the AVM matters, we often give a right to the observer to take a decision on behalf of the entity on which has in fact nominated it. So an observer essentially has a very kind of a sterile role to play on the board, but it's definitely a very crucial role as well, because there's a lot of information and a lot of data that flows from the board through the observer and into the investor that has nominated it.
Absolutely. Thank you for that elaborated answer, Sanya. Next question is from Mansi. She's asking, could there be any cap on drag along shares?
See, the concept of drag works in this way. Suppose, for example, an investor has 100 shares, right? And there is an exit that has not been provided. So the investor has basically taken its shares to a third party for sale, and the third party says that they need 120 shares. Now, the terms of the sale would be that the third party will only purchase the shares of the exiting investor if they are able to procure those additional 20 shares. The part of the reason why third parties tend to do this is because they want to procure perhaps a larger shareholding in the company and not just the shareholding of the exiting investor. So in those cases, for those 20 odd shares, there is a drag that is typically taken on the founder's shares. So 20 of the founder's shares then get dragged along with the 100 shares of the exiting investor, and they are then sold to the third party on the same terms, on the same pricing, on the same conditions as are being offered for those 100 shares of the exiting investor. So the cap is an inbuilt mechanism of a drag, because the drag only triggers for that portion of the shares which is in excess of what the selling investor actually has.
Right. Next question is from Harsh Kothari. He says, according to you, that IN and BioAngels is sensitive to founders' name in forming term sheet, but in case, like in general, what are the caution points for founders in the market apart from IN and BioAngels?
Caution point for founders, I think, if I were to put myself on the founders' shoes, I think founders really need to understand, that investors are investing in the company and they want certain rights. See, remember that when investors invest, there is really no collateral that is taken. That is not how it works at all, right? So investors are basically investing on the backbone of the founders. So there are certain rights that investors would like to take. It could be everything from preemptive rights to anti-dilution rights to liquidation preferences to, say, even exit rights, for example, or reserved matters. From a founder's perspective, I think they need to be not so much as cautious, so as to say, but to kind of understand the perspective of the investors and why they are seeking those rights. Because at the end of the day, investors are doing two things. One, they want to protect their financial interest in the company. And secondly, they want the company to prosper. They want to be part of the growth story of the company. So investors are, for the most part, extremely aligned with what is in the best interest of the company, because in a very roundabout manner, it does kind of benefit them as well in the longer run. And that is the reason why founders need to kind of, whenever they are negotiating with the investors on any of the terms, whether it be on a term sheet, whether it be on a definitive agreement, they need to really kind of understand where the investor is coming from. Similarly, investors, as investors, we also sit down and understand from where the founders are coming from, what is their concern. And we try to, kind of tweak our commercials accordingly. And we've done that across so many deals in the past, where we have gone out of our way to kind of make sure that the founder is comfortable with the terms that we are providing to them. So yeah, so from a founder's perspective, yes, I think it's very important to understand where the investor is coming from, what are their core concerns. And it would be great, and very often we see that founders are also able to kind of assuage our fears, our concerns, and then deal can progress very well in those situations.
Absolutely. So next question is from Rajesh. What will be observing period for term sheet?
Observing period. See, essentially, I'm assuming that I'm assuming that the question basically pertains to the time period between the date the term sheet is executed and the date the definitive agreement is signed. Now, an observing period, essentially it would mean that, once a term sheet is executed, the next stage that we go into is a due diligence stage. And we undertake a very, very, very thorough due diligence, both a legal due diligence, a secretarial due diligence, as well as a financial due diligence on the prospective portfolio companies. And basis the due diligence, a lot of the issues are identified, and we've typically seen multiple issues, from everything from a compliance perspective, from a legal perspective, and those are all then rectified prior to the call for monies, or prior to the investment, essentially. So a lot of these issues that are identified during the due diligence is then put into as either it goes into a condition precedent to the closing, or closing of the investment, or it goes as a condition subsequent to the closing of the investment. And we have kind of, over a period of time, understood which are the business critical matters which need to go in as a condition precedent, and which are not so much business critical that could be put into a condition subsequent. And once that is completed is when the investment actually takes place. So there could be a gap of between maybe say 45 odd days, maybe 40 to 45 days before a term sheet is signed, and we're looking at a definitive agreements being executed. I hope that was the question.
I hope so too. So next question is, what is the difference between a lead and a non-lead term sheet?
So effectively, a lead and a non-lead term sheets, these are both term sheets, but these are two different terms that are provided, terms in the sense, investment terms, which are provided, one to a lead investor. A lead investor is typically the investor that is leading the round, bringing in the largest chunk of investment, whereas the non-lead investors tend to follow the lead into the investment. They typically have smaller check sizes. So when you have a larger check size coming from a lead investor, you're looking at having to give them certain preferential rights. Those preferential rights could be in the nature of enhanced information rights, enhanced reserved matters. Maybe you could give them a board seat to a lead investor, but not to a non-lead investor. So essentially, the difference between these two term sheets is that one term sheet has a greater number of rights over the company that is provided to the incoming lead investor, whereas the other term sheet would not have those rights. So when we are drafting and when we are kind of negotiating a term sheet, we have to kind of look upon us and try to understand whether we are a lead investor or whether we are not a lead investor. Because if you're not a lead investor, it doesn't make sense for us to request for a lot of the lead investor rights to be included in our term sheet. So that's again a very, very fine balance that we have to do. And it could be done on the basis of our percentage holding in the company, could be done on the basis of the ticket size that we are putting into the company.
Right. The next question, Sanya, is what are the rights an investor would always want versus other rights that an investor is okay to give away?
I think from an investor perspective, you're looking at rights such as, of course, you want liquidity. So the liquidation preference is a very, very important right for an investor, because God forbid, in the event the company goes south, in that cases, if you have preference shares and if you have liquidity preference, then whatever is the value that you get out of the liquidity event is then first distributed to the holders. Say we typically call it the first stack liquidity preference investors. And thereafter, whatever is left beyond that goes to the other shareholders and the founders. And in the other shareholders, you're also looking at people who have ESOPs. So liquidity preference is one. Secondly, you're looking at exit rights, because all investors would want an exit, and the rights in respect of an exit. So as we mentioned in our slides, that there are multiple ways in which an exit can be provided. It is not always an IPO. In fact, it is rarely an IPO, but there are ways such as a buyback, we say a trade sale or a strategic sale or a third-party sale, and particularly a drag. One of the reasons why a drag is so heavily negotiated is because it is pretty much a mandatory requirement for an investor to ensure that they're able to exit the company. So liquidity preference, exit rights, drag along, these are pretty much the rights that an investor will have. The other right that we have often seen investors really not give up on is the right of preemptive right. because when an investor is already invested in the company and the company is raising a subsequent round, pretty much all investors would want to kind of take part in that round as well, maintain their shareholding in the company, or at least take part in the growth story of the company. So preemptive right is another right which investors typically do not want to let go
of. Got it. The next question is from Siddharth. Apart from the investment, how do founders ensure that investors deliver on other agreements such as driving revenue through the uh, partnerships they have said they would drive, especially in a difficult domain such as health and biotech with multiple entry barriers to sell?
See, effectively, what investors' primary commercial terms, so as to say, would be is basically to make the investment. So once the definitive agreements are executed, you may have a first tranche, second tranche. You may have a first tranche closing, a second tranche closing. Once the money has been remitted to the company, investors have, for the most part, done their work. I think what the question pertains to is in certain situations wherein the investors are also kind of strategic investors, so they're bringing much more than just money on the table. And I think that for the founders, that's not something that you can really capture on a term sheet or or in a typical SHA. There has to be a separate definitive agreement that is brought in, which effectively details out what are the value additions that the strategic investor is going to undertake in the company. And I think what is really very essential is that you really need to understand and have a very definite milestones and timelines in place. One of the things that we sometimes put into our term sheet is also tranching and milestones. In, say, for example, the biotech space, where you have like very long gestation period, we have to be very, very careful as to how we are, spacing out those tranchings, how we are spacing out those milestones, because they may be across a very wide period of time as opposed to a very traditional industry. So I think, from my experience, when you get into a deliverable like agreement in respect of deliverables, the timelines need to be very, very strictly provided, very clearly provided, so there is no ambiguity. But all of this has to be done through a separate agreement. I don't think that this is, that it's a very good idea to kind of capture these in an investment term sheet or in an investment document, so as to say.
Great. To know that, Sanya, now we are moving to the last question of the session. Having said that, if anybody has any further queries, please feel free to write to us at info@bioangels.vc. The last question is how to ensure right transference between investing in an Indian entity and a foreign entity.
Well, I was really afraid that this question would come up. The government has come up with the revised ODI rules, and we are still in the process of doing a deep dive on these rules, and trying to understand exactly how these rules affect not just individual investors, but also corporate investors as well as alternative investment funds. As you must all be aware, Indian Angel Network already has a 350 CR Iron Fund 1 that has been completely deployed. We have also very recently launched the Iron Alpha Fund, which is the Fund 2, which is 1000 CR fund. So obviously, when we're looking at the new ODI framework, all of these is something that is kind of really throwing up a lot of questions to us. My view is that an individual, so I'm going to split it into multiple bits. One is, of course, investment by a corporate entity into an overseas entity. Yes, that is allowed, subject to 400% of their net worth. That is the limit. I understand that startups actually fall under the strategic sectors, wherein by government approval, as a permission from the government, you can invest more than the 400%. That is my understanding. Similarly, into startups, if a resident individual is investing through the LRS route, then the 250,000 USD barrier may be breached if you have appropriate government approval. In terms of AIFs, AIFs are also entitled to invest in overseas entities, but in terms of the new ODI rules that has come in, investment by AIFs into an overseas entity that comes under the overseas portfolio investment, it's not considered as an overseas direct investment, whereas for corporates and individuals, when they're investing in equity shares of a company, it is typically considered to be as an overseas direct investment. So essentially, I think there's a lot of gray area in regards to things like overseas undertaking an overseas investment, or looking at a flip of an investee company overseas. And I think we should all be getting some answers to that in the next few weeks. We are also very heavily involved in these matters, and we are constantly trying to be at the forefront of understanding how these overseas investment norms are going to affect our investors and our funds.
Thank you so much, Sanya, for this engaging session. We have now reached towards the end of the session. Thank you so much for joining us. We are grateful for the time and effort you took to share your wonderful insights with us on this topic.
Thank you, everyone. Thank you for joining. I know it's pretty much towards the end of the weekend. I wish you all a very entertaining weekend, a very relaxing weekend. Thank you again, everyone, for joining in. Have a great day.
Thank you so much, everybody, for joining us. Hope you enjoyed the session and we added value to you. Goodbye, everyone. Have a great weekend. And